Hey, good morning, everyone, and you're very welcome to this morning's session of the Coffee Microcaps Morning Meeting. My name is Mark Tobin. For anybody who's joining us for the first time this morning, I am the founder of Coffee Microcaps. I've got a couple of quick intro slides I'm going to run through here, and then we're going to get straight into it with our first presenter. I'd like to mention our online sponsor here for all our virtual events at Coffee Microcaps, RAS Research as a Service. If you are looking for some research on some small and microcap ASX-listed companies, please do check out their website. And indeed, for this session, I will be sharing some of the research that RAS undertakes on some of the companies presenting this morning. So do just watch out for that popping up in the chat in your nav bar. A quick compliance and disclaimer side, and a welcome to any of our guests from ASIC this morning. For anybody who is joining us for the first time, the companies we normally have presenting on here generally on a bi-weekly basis are capped under 300 million, are in revenue, generally approaching cash flow break even, or indeed are already profitable. We generally don't tend to have companies from the resources and biotech sector at these events. And it comes down to then industrial microcaps, so what I call industrial microcaps, which includes financial services, technology games, healthcare, FMCG, hardcore industrial businesses, and if anything that kind of falls out of resources and biotech. Structured this morning's webinar, we've got a full deck this morning. We've got 4 companies presenting. Each company is going to get a 30-minute slot, which will break down into a 20-minute preso and 10 minutes of Q&A. If you do have any questions, please type them in the Q&A box in your nav bar rather than the chat function. Just makes it easier for me to moderate the questions to our presenters. Please note the webinar is being recorded and will be posted on the Coffee Microcaps YouTube channel on Tuesday morning. You can follow us pretty much on all the socials. Twitter is probably our main one. As I said, YouTube for the recording of this webinar, and indeed all our previous webinars. We've got well over 200 company presentations on there now. LinkedIn you can also get us on, and I write a free monthly newsletter which you can grab on the Substack platform. And our first presenter up bright and early going to be joining us from Perth shortly, Keith John, MD of Pioneer Credit. And we're going to come back over this side. We've got somebody who should be no stranger to the Coffee Microcaps audience, Martin Filz from Pureprofile, coming back to give us an update. Then joining us for the first time, I'm delighted to say we're going to have Ian Olson from Pointerra. We're going back out west again for Ian. And then we're going to stay out west. 3 out of 4 are based in Perth this morning. And we're going to have Chris Clark, CEO of RocketDNA. Again, somebody who should be no stranger to the Coffee Microcap audience. Chris coming to give us an update on their Q3 result. But that's enough from me. I am going to stop sharing my screen and hand you over to Keith now. Keith, if you want to start sharing your deck, I'll let you know when I can see it coming through. Yeah, I can see the cover slide of your presentation now, Keith. You can take it away.
Thanks so much, Mark, and thank you everyone for joining us this morning. I'm going to take you through a brief overview of Pioneer Credit, who we are, what we do, and why we exist in this market and in the markets we participate in. A little bit about the size of our business and the opportunity set that sits in front of us, and of course some of our financial performance, and then update you on our outlook for this year and what it looks like in 25 and 26. So a little bit about us. We're a debt recovery business, but we specialise in acquiring and servicing what are retail purchase debt portfolios. So what that means is we don't act for anyone else in the sense that we don't collect on behalf of third parties. We buy portfolios of impaired credit, predominantly off the big banks and the non-bank lenders. And we bring them onto our platform, and then we service those consumers ourselves and for our financial benefit. As I said, they're all held on balance sheet. So everything we get, we own, and we bring that in. That builds a lot of resilience into this business, particularly when you go through periods of disruption like we did through COVID. We have no exposure to the Northern Hemisphere. We're a Australian-centric business. There's an incredible growth opportunity that exists for us here. We're the number 2 player in this market by total investment, probably the number 1 player in the banking and finance market, but there's a huge opportunity for us to continue to grow market share in that particular part of the market. Since 2008, we've invested almost $750 million into these purchase debt portfolios. So that's an incredible amount of money that we've invested. We've been very successful. That's across about 5.6 billion in receivables and 720,000 customers. So that gives us this incredibly broad data set from which to build our business, look out for our business, and to use that to price portfolios and all the things that are important when you're thinking about a financial services business. We currently have an active base of about 210,000 consumers across just over $2 billion. And of that, about $450 million are performing. So these are customers that are paying us on a weekly, fortnightly, or monthly basis, just like a performing loan book in a bank. And really importantly, you know, this goes to the heart of why we exist. We talk here, our people are founded in good and they have a strong social conscience. Our business since inception has always understood the importance of the consumer, the need to treat consumers well. And this has become very relevant in banking and finance in recent years. And as a leader in this part of our sector, we're very much valued by the vendors, the people that we buy the debt from. In terms of our market, our position is really structured across 4 key elements. First of all, we have a unique servicing approach. Pioneer works really closely with the customers it buys. The people that we buy and we bring onto our platform have had a life event: death, divorce, sickness, might have lost their job, domestic violence. They've had an event that's caused them to not be able to pay their particular account. We work with them over time to get a good outcome for them and a good outcome for us and our originators. And that's very unique in the way that we go about that approach. We are one of the few scaled participants in this sector. Scale is very important. This is a very expensive business to run. We have very tight compliance and governance obligations, which are really important, but they're very costly to implement and to audit. And as a business, scale is very important, the way we bring in data into our business and so forth. So we're one of the few scaled participants in this sector. We have a market-leading reputation. This business is not driven, or this sector is not driven by the price someone pays for portfolios. It might have been in the past, much more skewed that way. Now the world's changed dramatically, and the banks and the non-bank lenders want to be dealing with a group that has a market-leading reputation, that will treat consumers right, that will protect the brand of the originator. And Pioneer's got a very strong and enviable reputation in that regard. The other part is we do not offer further credit to customers. So we buy these consumer accounts, these consumers get healed, but we don't compete with our vendor partners, unlike some others. And because of that, we're getting more opportunities than what others are seeing. So in other parts of our market, groups are talking about contraction and market shares getting difficult for them. A large part of that is because they compete with the people that are selling the portfolios. Pioneer doesn't do that. So we're aligned to our vendors in getting good consumer outcomes. In terms of market activity, macroeconomic, you know, everyone's concerned about cost of living and interest rates. As far as it goes to consumers and to retail credit, they're performing remarkably well. You know, we remain fully employed in this economy. Australians have this very strong sense of obligation when it comes to meeting their financial commitments. And I think we're seeing that come through, not just in Pioneer's results, but in the bank results and the non-banks with the low debt levels. in terms of our market, regulatory and reputational issues are really creating a moat around this business and making it very difficult for new market entrants. That's a good thing for us. And vendors are selling more, but they're being very selective. They're preferring to partner with groups that have got strong relationships with them, such as Pioneer. And from a competitive perspective, there have been a range of market exits over the past few years. We're really down to a duopoly in terms of the banking and finance market, and that's really healthy for our business. And there's a few more opportunities that exist there, as there are with mergers and acquisitions. And as Pioneer continues to build its business and continues to build the value back in its equity, these are opportunities that we'll be able to avail ourselves of. In terms of investment, so we're in a business that invests about $85 million a year in portfolios, as you can see over the last 3 years. We've got the historical context there as well, and you can see from 19 to 21, things peeled off through COVID. We're back to 85 million. The business grows once it's spent or invested about 65 million per annum. We think we can grow this to 125 to 150 per annum over the next couple of years on a run rate basis. So really healthy outlook for us. Importantly, we're buying at better than historical IRRs across our FY24 vintage. So whatever we've bought this year is at better than historical IRRs. And I think that's reflecting a couple of things. One, again, is our superior servicing arrangements and our enviable reputation. 2 is part of the shrinkage of the market. And 3 is this desire for people to partner that are partnered with them, and they're prepared to pay a little bit more for that. And that makes sense to us. One of the ways we demonstrate very, very clearly to the market about the way we look after consumers is through Net Promoter Score. And if you think about our business being debt recovery, this is where we ask people, how likely are you to refer Pioneer to a family or friend? We have a Net Promoter Score of plus 23. It's a remarkable score and has been relatively consistent over the last couple of years, but really reflects how well we look after consumers. And you can see through there, at first contact, the score's minus 40. So this is the time we buy the account from the bank or the financier. And as we work through those cohorts, the scores increase quite dramatically. We measure every interaction with a consumer. So the score of plus 23 reflects what all of the consumers, happy, sad, excited, energized, what all of them think about Pioneer. And it's a really important part of how we demonstrate to our vendor partners how good we are at our job and how we differentiate ourselves, and also how we keep a track on ourselves of how are we actually going, how are we engaging with consumers, and are we actually looking after them in the manner that we say we will and the way that we intend to. In terms of our portfolio, we have an opportunity set of about $2.1 billion. So that's the total amount of receivables that are owed to us. And of that, it's broadly split into 2 parts. We've got a performing portfolio that's been growing at a CAGR of about 10% over the last sort of 4 or 5 years. That's about $450 million. So these are customers that are paying us on a regular basis, just like a normal performing loan portfolio. And we get about half of our monthly revenue from that. And then we have our WIP. So these are customers that we're onboarding and then working with them to improve their situation so they can commence meeting their financial commitments. That's about $1.7 billion. And we get our other half of our revenue through here. Some of those customers become performing and we grow that book, and others pay us in lump sums or sporadic type payments. The deeper we can dive into that book, the deeper we can reach into it by using better analytics, leveraging our scale, will result in even better outcomes for our shareholders in the years to come. I think one of the things that really separates Pioneer from most every other small financial in the market is our alignment to shareholders. It's not just that we are the largest shareholders in the company. That's a really critical part, but it's actually about the way incentive works in our business. No one in my leadership team or my executive receives a short-term incentive. The assets we buy pay us back generally over a period of about 4 years. And as such, it has always been the case that we only run a long-term incentive program that pays out now over 4 years. So there are 3 yearly targets that are set, and then if those targets are met, the incentive rolls forward, and then they must hit a 4th target for those incentives to be released. The program that we're in currently requires us to deliver a statutory net profit after taxation of at least $18 million in FY26. So if we deliver that, then these incentives are unlocked for our team. This ensures that I've got a team that is motivated for the long term, that when we invest money in these portfolios, we are thinking about long-term outcomes, not about hitting a short-term hurdle. And I think that alignment is very, very, very important to shareholders and separates us from most everyone else. Of course, $18 million against our current market cap looks quite remarkable, but it's a target we fully expect to deliver upon in 26. In terms of our financial performance, this is for the first half, so extrapolate it across the full year, and I suspect you get to a reasonable expectation of what this business should be delivering. $75.6 million in collection, so that's the actual cash that we received in the first half in our business. EBITDA, not a great measure in financial services businesses, but one that so many people understand. None of these numbers are normalized. This is just straight out traditional definitions. $49 million. So this is a highly cash generative business. EBIT, just shy of $18 million. The delta being our interest costs, and I'll get to that in a minute, but $18 million of EBIT and a small net profit after taxation for the period. It was the second half in a row that we've delivered an NPAT following some the corporate activity that beset this business in 2020. In terms of our profit and loss, you'll see there a relatively simple business in terms of how it runs. The biggest expense lines really are employee expenses. They rose a bit through compared to the prior half. There's about $1 million a year in non-recurring expenses we expect to be able to pull out as we bring the end projects and other parts of our business that are occurring over the course of the next year. Amortization. So this is kind of like the cost of goods sold concept. If you think about that, we buy a portfolio for $1. If I collect some money, I must have a charge against that, and that's our amortization charge. And ultimately, it's our interest expense. We're currently paying about 13% for our interest. We expect that to drop dramatically by the time we complete our refinance, which is expected to occur before the end of this financial year. And that is going to save us somewhere in the vicinity of $8 odd million per annum, and that drops straight to the bottom line. So we're a business that's got great growth opportunity in front of it, a reducing cost base, and one that collapses immediately upon refinancing our senior facility. We remain exposed to the BBSW cash rate. So if interest rates come down, then that'll be a bigger saving for us. Net assets of about 43 million at the moment. There is also a deferred tax asset that is not on the balance sheet currently of about $25 million. So that will come back on board, and we've obviously got a good period of time where we're not going to be paying tax. In terms of our outlook, few things to mention. First of all, we raised $10 million in March as we go through this refi process. We didn't want to draw down more debt. We raised $10 million at a premium to market. Doesn't happen very often. And that supported us growing our portfolio. There's a huge opportunity there for us. There are 5 main things that we're focused on. Continued industry regulatory focus. We've called this out for a number of years now. That's a really good thing for this business because it builds out that moat around us, something we like. Strong tailwinds for investment opportunities. We upgraded our guidance. We started at 60 million at the beginning of the year. We upgraded to 85 in late last year, and now we've upgraded to an investment of $95 million just earlier this month. That provides us with good growth going forward, and there's a lot more opportunities. We've got agreements in place with 12 vendors at the moment. We've got a 5-year agreement in place with the CBA. That's a beautiful way to underpin our business, and there's significant opportunities coming to market. Reduced cost of funds. Nomura, who have financed us in the past and also are a substantial shareholder in the business, are exclusive arranger for our senior finance facilities. As I said, we expect that to close this half with material savings to be realised immediately for us. Realise operating leverage. Important part is you get to scale, you need to make sure you continue to pull out cost. We've got a core system replacement where we're re-platforming our business. That's well progressed. We're sort of 2 years into that now, and that'll be completed relatively soon. That will deliver great efficiencies for us in FY25, and there are other cost out opportunities for us, again, as we continue to scale. Finally, material uplift in NPAT. There's great supply of portfolios for us into a fully employed environment. We expect significant savings to flow through next year, which will, drop straight to the bottom line. And as I've said before, we've got an LTI target for FY26 of an NPAT of at least $18 million. So that's what we're fully expecting to deliver on. That concludes my formal part of the presentation, and Mark can open the floor to questions.
Yeah, thanks, Keith. The questions have been coming in thick and fast there as we're running through the deck. So let's jump into them. One, I want to touch on the refinancing because you called it out there. A question around the refinancing gets done. Let's just assume that timing we'll see what happens. Could be, as you say, you're aiming for the end of this financial year, but even if it falls into the early part of next year, dividends, if it comes back into play, once that refinancing, is that part, or is the plan that frees up a hell of a lot of capital that can be redeployed into PDLs? Maybe just give us a sense of what the board is thinking once the refinancing is done and dusted.
Of course, Mark, thank you. Look, I mean, historically, this has been a business that's been a very strong dividend payer. In 2018, I think we were making $20 million NPAT, and our previous policy was that we pass through 50% of our divvies, 50% of our profit is fully franked divvies. We'll get back there. Look, I don't expect that we're going to do that in 25. It's an option available to us, but we're also staring into an environment with incredible opportunity, and I can't see at the moment that passing through dividends is a better use of the capital than investing further into the market. The other part about that is the points at which we're investing now are very accretive, so it's reducing our leverage, which over time will also reduce our cost of funds. So we need to balance that. But we're alert to dividends. I'm the major shareholder of the business. I'd certainly like some dividends as well, but we need to balance that across what's good for all of the shareholders and the health of the business. And I think at least for the next year, we should expect that that's going to include just continuing to reinvest in good accretive opportunities.
And then a question on maybe just you know, you mentioned you're the number two player. The size of the PDP market that, or I think they meant PDL market here, that PNC plays in, you know, it's kind of overall size, and where is kind of a natural ceiling for, you know, your annual investment amount? Let's assume
Yeah,
refinancing is done, and we maybe look at, you know, on a medium term basis.
for sure. So the market's about 350 million this year, probably grows a bit more next year, I think. So think about it as a $400 million market. About a quarter of that we don't play in. So we don't do anything related to payday loans, okay? And we don't do anything related to sort of lower quality credit. Currently, we don't play in we don't participate in the utility and telco sector. So, you know, the part of the market that we're in currently is, you know, in the vicinity of 300 million. We think we can capture somewhere between 125 and 150 on an annualized basis and rolling basis without having to reduce margin. And that's the way we think about our business. You know, we don't need to be the biggest. You know, our goal is to be the most sustainably profitable. So that means getting to the right stage or the right size of market and right size of market share and repeating that. And that then will throw up a beautiful opportunity for us is, what do you do with the extra cash? These businesses and this business, at a couple of years of steady investment, once we've stopped growing and we just keep investing at a steady rate, it throws very significant cash. So that's an important offering from us.
Another one then, can you provide some context on why the performing portfolio has been relatively flat over the past 2 years? Is that just a natural seasoning of the book post-COVID?
Yeah, it's a good question. Look, I think the best way to think about it is really consumers are clearly challenged. A lot of our consumers at the moment are not entering into longer term arrangements in the way they might have in the past because they are more cautious about the outlook. So they don't want to make a commitment that they can't keep through with. So, of course, that book's paying down over time and it's holding steady. You'd expect it to start growing again, maybe when interest rates start to peel off a little bit and people and consumers start to feel a little bit more confident. You know, consumer sentiment across the country now is back to GFC levels. I mean, it's as low as it's ever been. And I think when those things happen, consumers continue to pay, but they also continue to keep a bit to themselves. You know, they need the security of not having a commitment that they might not be able to keep for some particular reason. Having said that, they've been able to keep them, and we've seen no degradation in performance whatsoever over the past 18 months.
And then another one, capacity within your client service collections team to handle growth, you know, metrics you can share there, or is that a function of, you know, the replatforming, replacing of core systems? You can, you know, keep the same staff, but they're actually more efficient now with the new system.
Yeah, certainly with the replatforming, our people will be more efficient. You know, at the moment, our systems are aged and legacy, and subsequently you have workarounds as things change through particular industries. We're moving to a platform that's sort of you know, enterprise grade across the world and used by banks and some of the biggest purchasers in the world. So we expect that to increase the efficiency. Look, we've got capacity to continue buying at sort of $100 or $120 million a year without needing to add dramatically to our headcount. And over the course of the last 5 years, our headcount's actually dropped by about 25%. As we've become more efficient with those legacy systems, we expect that efficiency to continue to build out over the course of the next sort of year or so.
And then a question here on kind of KPIs for Pioneer, and you did touch on it in the slide, saying, you know, EBITDA is not a great metric for financial services business. So the attendee is asking, you know, is cash collections kind of the key performance indicator, or what would you direct people to you know, when a deck comes out, you know, what's the kind of first number they should be looking at, and then use that as a kind of really base case to judge how the business is performing?
Yeah, for sure. Look, cash collections is, I think, the best metric, because, you know, you can't cheat cash. It's either in the bank or it's not. So that's a very good metric. We were fairly steady through the COVID years at about $100 million a year in cash collections, and then, you know, we've jumped sort of 40% over the last couple of years. So really good growth there. There's that. I think EBIT's a really important number. Again, it's statutory, it's audited, and it's reliable, and then of course NPAT. But we understanding the makeup of our NPAT's clearly important. We remove, or we fix that interest cost in the coming month or so, and of course that's going to open right up.
Yeah. Keith, we'll have to leave it there. And I just want to remind people, while Keith was presenting, I shared the latest RAS research in the chat there. So if you want to have a look at that or download it, just have a look in your chat function. Keith, we'll have to leave it there. Thank you very much, because I see Martin has joined us now from Sydney. So if I could ask you to please stop sharing your presentation, and we will welcome back one of our regular presenters here, Martin Filz from Pureprofile. Martin, if you want to start sharing your screen, it's coming through now. And just go to slideshow mode for us, please. Just so we get the full
Right, you should
screen.
be able to see that.
I can see that your audio is a little low, Martin. I don't know if you need to sit closer to your laptop or just turn up the volume slightly.
We'll try that. Does that work for you, Mark?
Yeah, that's perfect. That's perfect. Thank you so much. You can take it away.
All right. Good morning, everybody. And again, Mark, thank you for having us back, and thank you for Raz for organising the event. So fantastic here. Thank you very much. So we're going to give a short run through of May, of quarter three. This is similar to we presented in our quarter three wrap up. And please look forward to questions at the end. So firstly, for those of you who don't know, we're a data company. So we have access to over 21 million people around the world, and we access those people to either ask them questions, their views, their opinions, and or we gather data from them. It's all permission based. Everybody knows they're doing it, and they get rewarded for either sharing data and or answering questions. And we do that on behalf of our clients. We have over 800 clients around the world, and those 800 clients continually want to understand their consumers, if they're political parties, their voters, governments, could be issues that are going on, B2B, etc. And really it's feeding that market research industry, the $130 billion market research industry, with answers, so that we get better products, more targeted, relevant advertising, relevant content that we read. So that's what we do, and data is the new gold. So on the right hand side of this graph or table, you have platform. That's where we have all of our panels, the 21 million people. In the middle, very clever technology. We're an over 20-year-old company building technology throughout that time. And then on the left-hand side, we have clients who access either through managed services, through direct services. We have SaaS platforms that include DIY surveys, etc., or directly through APIs, so direct connectivity to all of our audience to access them and get their answers, solving their problems, answering their questions. So that's what we do fundamentally as a company. As we evolve and as the world evolves, we see as we look to 2025 now, financial year 25, you can see the yellow boxes. So we're increasing our data points. We expect that to increase to about 50 million global people. We're adding something called synthetic data. This means that actually you can start to analyze all this data to get the answers without having to ask the questions, clients having to ask questions. So it's faster, more efficient, possibly cheaper as well, and a wider audience can access that data. And then on the left-hand side, you have new clients, which include AI clients and those big AI engines that need what's called training data so that they can give their answers to their problems for their clients. We expand from quantitative into new solutions such as qualitative solutions, and then direct to client solutions, including such things as ad effectiveness, brand track. So what I'm talking about here is new revenue streams. So we enter into new revenue streams from new products and new clients, that AI world. What's the prize? As I said, we've got global peers. The total market is worth about $130 billion. Our global peers are between 150 million Australian dollars revenue and 1 billion Australian dollars revenue. Why are they that? Because they're particularly strong in the US and the UK markets. I've said this a number of times to the viewers of this. The UK market is 11 times bigger than the Australian market, the US market 40 times bigger. And those providers also have direct to client solutions. So that's the size of the prize. Where are we? Well, in the last 4 years, we trebled the size of our UK business. So we've got a really strong platform, over 15 people today in the UK market, a strong brand, a number of clients that have grown, a strong audience that we have access to. And really the absolute focus for us in financial year 25 is growing out that UK business, so that it's truly, we're winning market share, but it's truly representative of the size of the market, 11 times bigger than Australia. I said it's approximately 10 to $12 million business. Australia is bigger than that. It's upside down. Shouldn't be that case. And over the last 4 years, it's been a focus for us. We've done the same in the US business. We've trebled the size of the US business. We still do that through remote sales. And we're being very strategic about our investments there because it's very easy. It's a big market, very easy to spend a lot of money, not get a lot of traction and not get movement. So 25 is the absolute focus for UK. And then 26 will be the absolute focus for us as a business for the US. Also, across all markets, we're building out our solutions. Our platform revenue today has grown to 20% of our revenue. That's all of our SaaS products, all of our automated products. 4 years ago, that was practically zero. And also, as I said, identifying new client solutions so we can cross-sell clients and offer more revenue streams to our business. And as an industry, we have fantastic tailwinds. We have quality issues across the industry, verifiable, real people answering real questions, sharing real data is a challenge. It's not within Pureprofile because everything is permission-based from real people. Our peer group, that audience, the 150 million to $1 billion, again, they're having different business changes, business challenges. Might have been companies being purchased by private equity who are restructuring businesses, refinancing debt in other ones, pivoting in other ones. And that's a great opportunity for us where we're winning market share and also attracting great people to our business who want to work for a growing organization such as Pureprofile. We attract great people because we are growing, because we have great branding within the marketplace, fantastic employee and client satisfaction. So that means we're able to access fantastic people in new markets and expand. And then the last point is this rise of AI. And you need to think about AI in 3 different ways. Firstly, internal efficiencies as we roll out AI solutions to be a better, faster, more price-sensitive organization, more efficient, growing our EBITDA margins. And already we've rolled out a number of products and talked about those before, such as AI translations, the way that we analyze data, the way that we provide data to clients. That's the first group, internal efficiencies. The second one is looking at the way that we have solutions that we can deliver better to the clients, new solutions, innovation, faster innovation, and the way that we can again help clients to answer their questions in a better, faster, more cost-efficient way. And then the third group is looking at AI as a total entity. So that's clients, new clients that need AI or have AI training data, and they need that verifiable data from Pureprofile so that they can prime their engines to make better predictions, give better answers. And also looking at potentially Pureprofile and how can Pureprofile actually enter also into that AI engine space now with access, as I've talked about, with close to 50 million people in financial year 25. What have we achieved in the last 4 years? Well, our revenue CAGR has been 27% over 4 years, to financial year 24, including our mid-range of guidance. And I'll talk about guidance in a minute. Our rest of the world revenue had an absolute strategy, which is to grow the company internationally. We've grown rest of the world revenue from 29% total revenue in financial year 20 to 43% at the March year to date. And the goal is obviously rest of the world overtakes Australia. Our EBITDA, we've had a CAGR of 57% over the 4 years to financial year 24, mid guidance again. We achieved profitability in H1 financial year 24 for the first time ever, true NPAT profitability. And 4 years ago, that was a net loss of $9.8 million. We've been operating cash flow positive for over 3 years as a company. We've grown our client rate, number of clients from 550 to 800 March year to date. We've grown our international offices from 5 to 13. Our platform revenue has grown from 0.5 million to 6.5 million March year to date. We've grown annuity revenue from 3.5 million to $10 million on a rolling 12-month basis over the last 4 years. We've enhanced our technology platform with new technology, investing in our existing technology, and then looking at new developments, SaaS developments, client connectivity, internal efficiencies, and AI. So I joined the company 4 years ago, and we had a clear strategy around 3 areas, which was 1, focus on data and insights as a company, and we've divested of our media businesses to absolutely focus on that business. 2, grow internationally, and you can see that that's been and is being achieved. And number 3, grow out our technology platforms. And again, examples like how our platform revenue has grown from 0.5 to 6.5 million shows that that is also being achieved. So diving deeper a little bit, looking at Q3. So Q3, our revenue grew 6%. It was a record Q3 for us as a business at $10.9 million. We actually had softer Australian trading environment, and listening to Pioneer Credit, it's a soft market today in Australia. That's not true in the rest of the world where we're eating into low market share, but Australia is soft trading. And so we had a soft January and February compared to prior year. But actually we saw March up 16% on PCP. So that's great. And actually that's continued, and hot off the press, our April numbers, it's 21% up on PCP. So that's really exciting. And we've seen that we've reacted and responded to the softer market with a number of initiatives and seeing that growth here in Australia. We've always seen the growth in the rest of the world. That revenue is up 11% on PCP. And again, slightly boosted, especially with strong growth in the UK as we start to expand our UK business for next year. EBITDA actually declined in the quarter. We had a change of the way that the executive remuneration, it's gone from share-based payment to removal dilution to cash-based. So that's one element that affected it. But also we had several operating expenses or several investments that were higher. This is due to higher staff expenses. We opened up a German, Spanish offices, so there's higher expenditure within there, which gives us growth outside of ANZ, and also some higher technology expenses, rolling out ISO 27001 accreditation that gives us access to government projects that we hadn't previously been able to do. So that's really exciting. And again, we'll see that come back in the remainder of the year. As I talked about, Australia market picked up to 1% growth, rest of the world again 11% growth, and platform is still at approximately double growth per quarter at $2 million. I talked about this a little bit, but as we look at ANZ revenue specifically, that's 16% over a 3-year CAGR, rest of the world 34% over a 3-year CAGR, platform revenue 124% over a 3-year CAGR, and 8% a 3-year CAGR for EBITDA, looking at all those metrics, looking at Q3. When we look at full year, March year revenue actually increased 7% PCP, and again, growth in outside of Australia up 18% on prior years. Highlights, strong growth we had in Q3 following a flat year revenue. So when we reported half year, it was flat year, and now that's grown to 7% year over year. Our EBITDA down 10% on PCP, but again, we had that change around the executive remuneration. So actually, if we exclude that, we would have been up 2% on previous year. And again, we now have almost zero dilution from any equity plans. So that's something that we have done. We're asked to, and that was something that's fed to for shareholders. Our key priorities for Q4, as we're well into that now, we're halfway through that. So it's returning that Australian business to strong growth in both revenue and profitability. And I touched on what we've already seen for April. Carrying on our international expansion growth, growing our data and panelist growth, so we're set up for a strong financial year 25, ensuring that all of those final internal AI solutions and other internal technology enhancements are finished so that we fully see the EBITDA margin expansion, we fully see the benefit in financial year 25, maintaining that NPAT profitability that we saw for the first time ever in the half year, and that's a focus to maintain that for the full year. And then as we look to financial year 25, it's ensuring we have the right teams and the right investment in place to really see that international growth continue and even accelerate and maintain that growth in Australia. We also revised our financial guidance. It was broader before, it's 46 to 51 million. We're able to hone that down to see revenue guidance of 48 to 49 million. And again, EBITDA margin was previously 3.2 million to 4.6 million. We're able to hone that down now to 4.1 to 4.5 million. So good growth in both elements for us as a business, and reaffirming that guidance that we released firstly at our AGM, and actually being able to have stronger, tighter guidelines around that. So in summary, we had record continuing business for our third quarter revenue, despite those challenging trading conditions we saw in Australia. We've seen an absolute recovery in trading conditions, with March being up 16%. And as I said, hot off the press, April was up 21%. Our international business continues to grow faster than the ANZ growth rate, which is absolutely right as we eat into that market share that we don't have. We also have a broad refresh underway, strengthening our board with areas around industry experience, and that should be completed at the end of this month. We're aiming for. Process been underway now for five or so weeks. So we're very excited about that. And then finish the year strongly, achieve our guidance, implement the actions, ensure we deliver shareholder value for this year and moving forward. And with that, I will hand back to you, Mark.
Thanks, Martin. And I'll just remind everyone the last RAS research update note encompassing all those Q3 numbers that Martin was talking about. I've shared in the chat if anybody wants to download it. But let's kick off with a few questions. Martin, just on the UK market, you say it's 11 times, greater than the Australian market, but I mean, it's not 11 times the population. So why is the UK market, so much bigger? Is it just a more mature market? Is it, big American brands have their European office running out of London, and they're sucking work that might necessarily be happening in Germany, but they do it through the London team. Like, why is it so much larger than Australia, given you haven't got such a massive population difference?
It is exactly your last point, Mark. You should be in our business. So it is that out of the UK, it is a hub for Europe and international work. And so you see a large amount of international work. Up to about 40% of the market research, data and insights work that's done in the UK is actually international work. And that's very, very different to Australia, where you see 80 to 90% of all work in Australia is actually domestic work, not international work. So it's the economy is that much bigger in the UK, and then it's the international work that adds that additional layer in. And again, Pureprofile, one, we have offices across Europe now, but in addition to that, we also have panels and we have data access across all of Europe. So we are conducting all of that international work already from our UK base.
And I'll just talk about the platform business for a minute. In terms of how that compares to the rest of the business, just in terms of cost of goods sold and margins, I'm guessing it's much more of a SaaS-like business, or more of a technology type business, rather than a lot of the more I guess labor intensive, even with a lot of technology behind it. There's still a lot more bodies involved in the rest of the business rather than platform business. Would that be fair to say?
That again, absolutely fair to say, Mark. So today, about 20% of our revenue comes from all of our platform products, and we have 4 or so platform products or SaaS products and automation that sits in that platform revenue line, and 80% comes from managed service. So you're quite right. As we expand that platform level, then our managed services reduce, our overheads reduce, our fixed overheads. Already, a lot of our overheads, we have about 100 people in India and the Philippines, like more, it's about 110 people in India and Philippines. Amazing team, do a fantastic job. But again, what we're able to do is then expand without adding further to that team. And so as you've seen our EBITDA margin expansion, and I think 4 years ago it was about 3%, and expanding through the 4 years, that is in part due to what we do with platforms. So it's faster, there's more automation, takes less people, and actually also it adds to a higher quality point, because you've got a peer-to-peer, point-to-point direct access for a client. So there are less hands in between the handling of that data.
Question from the audience here, Martin. Let me just take this one. This is actually a good one. How do you acquire your audience you survey on behalf of clients, and what is your growth rate for acquiring audience?
Yeah, that's a really good question. So we acquire audiences in 3 ways. So the first way is we directly go out and we recruit audiences. And that might be by advertising on Google or Facebook or through affiliate networks. So we directly advertise. And so that comes into our audience, and we have our own panels around the world that we can build out. And we're putting our hand in our own pocket to recruit people that then do surveys or share their data. The second way that we do it, and it's a little bit of our secret sauce, So hopefully we haven't got any competitors listening. And we have a product called Audience Builder. And what Audience Builder does is it plugs directly into large loyalty schemes. So here in Australia, a partner that we have a number of partners. One we have is Flybuys. So if you go to the Flybuys app today, you can actually, and you go to a section that calls earning Flybuys points, you can actually do surveys to earn Flybuys points. So we have Flybuys members who do surveys, and in real time they earn Flybuys points that go into their Flybuys wallet that then they can spend within the network. So the advantage of that is it enables us to build fast audience, large audience really quickly and without putting our hand in our pocket. And we do a back-end revenue share with all of those partners. So the benefit is quick revenue streams for us, haven't asked spend any money. And the benefit for the partners is higher engagement because their members earn their points or their loyalty scheme by doing something else. They get lots of data and insights, which is what they want to do because they want to understand the consumers better, to upsell, cross-sell, etc. And then thirdly, the revenue share. And then the third way that we get our members is actually we rent the missing people. So we might do a study, let's say, for example, in Orange, or nationally, we're doing a study, let's say, on electric vehicle owners, and they want 100 electric vehicle owners in Orange, and we might in our own network have 95 electric vehicle owners in Orange. And so we actually go out to our network and we bring in the missing 5, ask them the same questions or ask for their data and share their data, and then away they go. And broadly speaking, if it's our own members, it's around about a 70 to 80% margin. If it's through our audience builder partners, then it's broadly around a 60% margin to our business. And if we're renting and letting go, it's about a 30% margin. So beneficial to have our own members, but we're putting our hand in our own pocket when we could be making investments elsewhere. So that enables us to revenue share with the audience builder.
And then I just wanted to go back to, you mentioned your peers in the industry, they're doing that kind of 150 million to a billion in revenue, but I think you said the overall market is like $130 billion. So it seems like it's quite fragmented if you've got, the largest players are only doing $1 billion in a $130 billion market. What's happening from a kind of M&A industry consolidation point of view? Is that happening, and how does that impact Pureprofile in terms of some of your competitors getting bigger, and at the end of the day it's all about who's got the best data and the largest volume of data, I think, in this game.
Yeah, so a really good question. There are M&A opportunities. As an organization, as a company, we need to be really cautious about that. Our market cap is very low at the moment, so it doesn't enable us to go out and make acquisitions. YouGov, YOUGOV, they're listed on the UK stock market. They just made an acquisition of audiences across Europe, and they spent 330 million euros on that acquisition. So clearly there's top end of town. Where we're looking at the moment is firstly, we can grow organically and carry on growing organically and carry on growing into that market share, low market share that we have, with a better service offering, better quality, and exporting everything that we do well in Australia. But also over the last few years, we've now built up a little bit of a balance sheet, and it perhaps enables us to look at small bolt-on acquisitions that maybe give us some small versions of Pureprofile that give us a little bit more data, maybe a little bit of software, and it gives us some acceleration into markets that we're already being absolutely focused on. So this isn't big acquisitions that move us in a separate direction, but small ones. And yes, certainly there are some opportunities of those. We look at those very carefully, and really under 3 criteria, which is, number one, it needs to be profitable. The business absolutely has to be profitable. Number 2, it cannot be dilutive to us as an organization. When we look to us as a business stay and our trading ratios as they alter, or KPIs as they alter. And then thirdly, it needs to be key to our strategy and it offers some sort of growth on our strategy. So we look through that lens. It means we reject a lot, but then we investigate some others. So it gives us small opportunity, Mark, as you said, for some bolt-ons with our current balance sheet.
Okay. Martin, I think we'll leave it there, and I'll just remind people, as I said, the latest research is in the chat there if anybody wants to download it. Just before we move on to our next presenter, I'm delighted to welcome for the first time, actually. It's been a long time in the making. We haven't been able to line up diaries in the past, but we've got Ian Olson from Pointerra finally joining us here on Coffee Microcaps. Ian, good morning.
Thanks, Mark. Great to be here, and great to see so much West Australian talent on your on your program today.
We got a hat trick of Western Australian
also
CEOs today.
Thanks to Finola from RAS Research Group and for your organisation for putting this on. I can see some familiar names in the attendees list, and so thanks to those people for joining, and also for the people that are going to listen to this in a recorded sense.
Yeah, Ian, if you just want to share your presentation, I'll let you know how.
I will do that right now. All right.
Yep, that looks
good.
How
are we looking?
You can take it away.
Awesome. So the theme here today, I guess, and I've been interested to listen to some of the other people present. The theme is obviously the quarter, so we will reflect on that. However, we've done a bit of a deep dive earlier this week with Finola, I should say last week, and there's some links on the ASX release today about that. But what I wanted to do, given that there was perhaps some people new to our story, was just give a recap about Pointerra and why we exist. So we exist because a group of people came together in 2015-16, faced with a potential solution to a common problem. And that common problem was working with 3D reality capture data. And some of the Nearmap founders, some very clever software engineers and mathematicians from Rio, and some people with the geospatial sector experience came together and imagined a different way of working with 3D data. And the problem is massive. The problem was massive back in 2015-16. It's even bigger today. And what we did was took some proprietary algorithms and we deployed them to the cloud. We built a SaaS business model on the front end of that. And we now talk about digital twins. Back in the day, we spoke about we spoke about data as a service and getting your data into the cloud so that we could help you access it and share it and move it around, and that led to natural conversations around, well, why are you spending so much money acquiring this data? What are you using it for? Well, people use remote sensing data, whether it's 2D or 3D, to manage their physical world. So imagine you've got an asset like an electric utility network. It's spread across 10,000 square miles. There might be 4 million poles. And part of keeping the lights on and meeting your service obligations and keeping your customers and regulators happy is knowing the condition of every single pole. And given that they deteriorate rapidly, there's weather events, there's vegetation encroaching on them, people put buildings and structures in the way. The only cost-effective way to understand the condition of the network on a regular basis is to use remote sensing data. So what does that mean? Satellite imagery, airplanes, helicopters, drones, vehicles, tripods, backpacks, tons of different capture modalities, 2D and 3D data. The common theme is I need to spend a ton of money to understand the condition of my network, or my rail network, or my road network, or my iron ore mine, or my oil and gas platform, so that I can figure out where the failure points are. I can direct my repair and maintenance expenditure, and I can get on top of sustaining CapEx and try and optimize that. So that's what Pointerra 3D does. We built a platform, we take people's data, we host it in the cloud, and then we build analytics solutions to help them interpret the data and get the answer faster. So we are, in essence, a workflow solution. So you take away all the hype, all the AI, all the 3D, all the nice buzzwords that people like. What we do is shrink workflow. So we help customers who, our largest customer in the US spends $20 million US per annum acquiring remote sensing data. And they were used to waiting 3 to 6 to 9 months to get the results from that data. So they'd contract an aerial contractor or a mobile contractor to fly or drive their network, and then they would wait 6 to 9 months to get the answers. Pointerra 3D shrinks that workflow from 6 to 9 months down to weeks and days, and for smaller captures, hours. So our business is all about shrinking workflow. And our mission is to help people who need to use remote sensing data to manage the physical world to do it more simply and easily. So, our branding and our tagline about simply faster is straightforward. It's incredibly complex and tons of desktop workflow, tons of desktop software packages to interpret 3D data. We've simplified that by putting it in the cloud, and we do it faster than just about anyone else on the planet. We go to market with a tiered solution, and we start with Pointerra 3D Core at the bottom of that value pyramid there, and that's effectively the foundation of a customer's experience with Pointerra. We get customers, they trust us with their remote sensing data. We deploy it in the cloud, and we sell that on a per seat and data limit basis. And that's a really sticky, because it replaces the existing way that customer might have worked with remote sensing data and digital twin data. By implication, adopting Pointerra and adopting Pointerra 3D Core means that they've fundamentally changed their workflow. And when you bake your platform into someone's daily workflow, it becomes very sticky. So that's our wedge into most organizations. Sometimes, however, the analytics piece, which is the next stack up, becomes it can be the tip of the spear. And that's where customers have massive programmatic needs, where they might be flying or driving an entire network and need an answer very quickly. However, the analytics is built off foundational data, and the digital twin that we build for our customers still needs to reside in Pointerra 3D Core. And of course, Pointerra Answers at the tip of the value pyramid there is about business intelligence. So when you've got incredible detail for a customer on a pole or on a street or on a suburb or a neighbourhood or a county or a state, that's fantastic for the ops teams. That's fantastic for the engineering teams who care about that level of granularity. But there are other parts of the organisation that focus on risk and planning and disaster response, and they're interested in network-wide views. And so we've built Pointerra 3D Answers, and that manifests itself in different nomenclature for different sectors. But the market-leading product we've got at the moment for the utility sector is Utility Explorer, and that really gives the executives of an electric utility a utility-wide, a network-wide view of the health of the asset. It allows them to run scenarios dynamically in the browser and really understand what the data is telling them. And it's particularly valuable when the utilities commit to regular data capture programs, because the most value you can get out of remote sensing data is change over time. So what we're all about is understanding change over time, using that to get into predictives. And for anyone who's been involved in asset management, predictive analytics are the holy grail. And that's what we help our customers do. So regardless of what they're doing, why they're capturing remote sensing data, what they're doing with it, what questions they're asking of it, and what they want to know about their asset, we build and deploy analytics and business intelligence solutions that shrink the workflow. So I've got the data, give me the answer. I'm not actually interested in the data. I just want the answer. But the workflow and the time frame that people have been familiar with and have put up with over many years in terms of the wait time and the loss of efficacy of that data is quite stunning. And so when you can introduce a value proposition that shrinks the time it takes to get the answer and do it accurately and quickly and repeatedly and scalably, we believe we've got an incredible value proposition. We came up with this solution back in 2015, and we deployed into the cloud, and we had our MVP in 2017, started signing up customers here in Australia, and popped off to the US in the middle of 18 and took advantage of the massive opportunity there for the electric utility sector. But through this journey, and up until last year, it was on a fairly traditional trajectory of growth, and And then we hit a bit of a hiccup last year when some of our US utility customers sat in rooms and undertook planning exercises for a year instead of doing their usual data capture programs. We've been really disciplined around the way we're scaling our business. First and foremost, it's people. The reason we exist today is because a group of people came together. It's not because there was a technology solution. It's not because of the cloud. It's because a group of people imagined a different way of helping people manage remote sensing data, build digital twins, and manage their physical world. So we've always invested in R&D, software engineering, and our dev team ahead of product and ahead of sales. And even today, the profile of our team is heavily skewed towards R&D, product development, and so you can't sell what doesn't exist, or you can try, but we see a lot of people out in the marketplace purporting to have hands-off fully cloud solutions, and the reality is a lot of them have mechanical Turks behind the scene, pumping away at desktops and pushing results to the cloud. Pointerra was conceived in a really disciplined manner as fully hands-off, fully cloud deployed, data in, answers out. So as we've scaled through 2018, 19, 20, 21, we've really identified and had some great success with the US utility sector. That's given us a roadmap for how to build out that product stack from the slide before, and we've leveraged that experience into other sectors. So what we've also determined is that each of our 6 market sectors, our go-to-market sectors, have an enormous total addressable market. And just focusing on Australasia and the US without thinking about the recent moves into EMEA, the TAMs in each of our sectors are well north of 100 million US ARR. So it's incredibly prospective. We know what needs to be done. What we need to do now to scale the business is to hire some more fantastic BD and salespeople who can get out into those sectors, have domain knowledge of those sectors, and talk with authority about the problems, and then show how Pointerra 3D solves those problems. We've always been very, very careful about how we manage our costs, and we've scaled our team in conjunction with the rate in which our customers spend money with us. And so we're not far from the point where operational leverage starts to emerge, where our cost growth and our cost starts to flatten off and create operational leverage, which translates to earnings and happy shareholders. And I'll come to that a bit later. Just quickly on the market sectors. When we started the business, we were very much focused on survey and mapping and AEC, because that's the area that a lot of us came from. The new map guys obviously were from the mapping sector, whilst the Rio guys were from the natural resources sector. They were very much engineering, software engineering, maths backgrounds, and obviously it's the foundational sectors that generate and use 3D and 2D data and digital twin data to map the world, and then design and build the assets that the people on the right hand side of the screen are interested in and own and manage and operate. That's where we started the focus. And indeed, those customers are incredibly sticky. They tend to be a lot smaller. The AEC customers are a bit bigger, but the survey mapping sector globally is very disaggregated. Lots of really small businesses, but it's very viral because they're capturing data across the different sectors: utilities, transport, resources, and defence and intelligence. So we get to see lots of new opportunities emerge because those survey mapping and AEC firms are retained by those asset owners to deliver them digital twin data. And in some cases, we see data flow from a survey mapping customer to an AEC customer to an end user customer. Each of those, just to reiterate again, each of those sectors have simply enormous TAMs. And the total addressable market in Pointerra sense is what does full deployment look like at enterprise level, where you've got a ton of seats and a ton of data, and you're fully deployed into their workflow in a recurring subscription model. And we've done the maths on the different sectors, and it's really compelling. We've demonstrated that some of our US utility customers find a way to pay us $3, $4, $5 million US per annum, and our largest customer has done that year on year for about the last 3 years. So we know product market fit for us isn't a question, and stickiness isn't a question once we get deployed, once people change their workflows. So our challenge is very much around finding the right BD and sales folk to execute on those opportunities. I'll move quickly through this, but the global geospatial sector is it's a bit like the automobile industry or the tech industry, in that each year there's new software iterations, there's new hardware iterations. Think of the hardware sensors like the automobile sector. The new models come out each year, so it's very capital intensive. It's very competitive. The margins are pretty skinny, but that sector, whether it's cloud helping the software side or all sorts of technology advancements helping the sensors get smaller and faster and more accurate, that creates a real tailwind that drives through lowering the cost of capture. Combined with the cloud, makes people less afraid about big data sets. And what were real barriers to adopting 3D capture in particular back in the last decade have more or less disappeared today, where almost every large corporation is cloud deployed, whereas 10 years ago were cloud diverse. And the hardware is getting easier to use. It's getting out of the hands of the geospatial professionals into the hands of people with perhaps with less skill, because particularly the SLAM-based LiDAR units are a lot easier to use. So we're seeing this structural tailwind flow across the geospatial sector, generating more data. The AEC sector, which is traditionally bums on seats, people charging time to jobs, has been forced to innovate, particularly with the deployment of capital in the Western world in the last few years. Responding off the back of COVID, we've seen in Australia massive investment in civil infrastructure. In the US, that investment tidal wave is only just beginning. The Biden administration's committed $1 trillion to rebuilding civil infrastructure in that country, and having been set up in the US since 2018, and building really strong relationships in utilities and expanding that out into road and rail and water, we feel we're really well placed to take advantage of that investment. And the only way that money gets into the ground is if the AEC firms that are going to build it and the asset owners that are going to deploy it innovate. And we just feel we're in a fantastic position to take advantage of that, but we still have to execute. So FY24 Q3 obviously was put out a week or so ago. The numbers are the disappointing bit, but the quarter was actually, for us, not transformational, but just a case of events unraveling as we thought they would. And what does that mean? It means that for much of last year, we talked about the pause in our US utility customers in the way they went about their annual capture programs, spending $5, $10, $20 million a year on remote sensing data, and then needing to interpret that. Last year, a lot of them sat on their hands with respect to those programs. They disappeared internally and figured out how they were going to spend and deploy this capital that had come through the Inflation Reduction Act, the near $1 trillion across the different civil infrastructure sectors. That caused a real ripple effect that turned into a bit of a wave for some businesses in the remote sensing, the aerial and mobile capture community, and then people like us that rely on the regular capture of that data to generate the big 6- and 7-figure subscription and program awards. So the quarter itself financially wasn't was well below par, but there was a couple of highlights there that I think signify to the market that what we've been saying is coming true, and that is that the utility customers are back out there. They're spending money. We got a $3 million contract award back in March from our largest customer. We expect more awards from that customer during calendar 24, and we expect to be able to announce further awards from existing customers and prospects in that space. But what we did, which is really important, circa this time last year, was realise that we had massive exposure. Whilst the US utility sector was running hot for us, it was great, and it was 80% of our revenue. We had massive exposure to that sector, and so when that sector sat on its hands for a year, our business really suffered. So we made a decision last year to focus some BD and some product effort into other sectors, and principally into AEC and into mining and oil and gas. and road and rail. So off a low base, but importantly, with some great success here in Australia, we've been able to secure and grow enterprise customers in tier 1 mining, tier 1 oil and gas, DOTs, so main roads, Transport for New South Wales, etc., some of the major DOTs in Australia, and some of the major rail networks. And just like we did with PowerCore back in 2018, we're leveraging that experience in Australia, where our dev and software engineers and product people are really close to the customer, and we're taking those learnings to the US and to EMEA, and seeking to take advantage of those significantly larger markets. So, we look forward to the balance of FY24 and then into FY25 with an expectation that we're going to see a growth, albeit off a low base, from those other sectors relative to the US utility sector, which in and of itself we expect to rebound strongly. So really the theme that I'd like to leave people with today about FY25 and for our US colleagues, the fiscal 25, which is a calendar year, is that we've got strong evidence that the US utility program delays are ending, and we know that the data acquisition programs are back on track, and that's starting to flow through into the need to interpret data. We're getting our sales order book and our sales pipeline is as big as it's ever been in that sector. We've had fantastic early success with our resellers, whether it's the Emerson relationship, which is sort of going to result in a large number of small customers, versus the relationship with our reseller in the Middle East, which has opened up opportunities in state-owned oil and gas across the Middle East. There's some fantastic opportunities that are again going to help balance out that reliance on the US. And I think we look perhaps beyond FY24 and into FY25 with some of those larger deals and existing customers and prospects moving further to the right on the sales pipeline continuum, and we're seeing the number of the growth in daily active users across our platform, which for us is one of those North Star metrics. And as we see those platform daily active users grow, that tends to drive growth in spending by our customers, and ultimately that will be reflected in growth in ARR. Nearly there, Mark. So our outlook and a message for people to take away before I take some questions is 5 catalysts to deliver shareholder value. And that is via high margin sustainable growth in our business. So we've got 7- and 8-figure ARR qualified deals that we're working on turning, and these are from new customers and prospects that we're looking to turn into cash in the next 12 months. We've got new channel partnerships where we've achieved some early success, and we're looking for more of those strategically to make sure that we can scale fast without adding direct cost to the business. Pleasingly, in the middle there, our existing customers are growing their spend. They're not going away. Program delays are resolved, and we're seeing growth in their recurring annual spend. So, as I said at the start of the presentation, our challenge is to find the right people to let on the bus at the pointy end. So the right BD and sales folk to help us execute on these opportunities, shrink the sales cycle for a product that we know is proven and a market that we know is massive. And on the right-hand side there, what does all that mean? What do shareholders care about? They care about us delivering into what we've been talking about for the past few years, which is sustainable growth in recurring subscriptions and getting to that inflection point where revenue starts to move away from operating costs. And despite some of the noise around our cost base, particularly in relation to our GP, if you strip out third-party contractor costs that have been a feature of some of the program work over the last little while, our GP in terms of platform SaaS revenue relative to the AWS cost remains in the 90s, and our guys have done some fantastic work in lowering our monthly AWS cost, both in compute and storage, as we've grown the amount of data to more than a couple of petabytes now, I believe. So what we've got is a massive library of data, a massive library of customers and prospects. We've got fantastic training library to use AI to make our analytics smarter and faster. And we're really looking forward to delivering into the promises that we've made to the market over the past few years. I think that's it for me. Mark. So I'll take some questions. Sorry, I ran over time a bit there.
No, you're okay. We've had questions coming in thick and fast, so I'm just going to apologise
Good
up
eye.
front. We're not going to be able to get all these questions to Ian in the.
That's all right.
Even if we had the full 10 minutes, we wouldn't get through them all. So I'm apologising if I don't
All right,
get to your
let's
question now.
Speed dating. Let's go.
Question around obviously AI super hot. I mean, everybody's talking about it, but it's also a super
You got
hot.
to use it, don't you?
It's also a super hot market for talent. So a question on, you getting talent into Pointerra who has the skills to leverage AI in a business like yours, which is very technology focused and is ripe for actually AI application. So maybe just a quick point on.
Yeah, I mean, we've scaled our R&D and software engineering teams since the get-go, Mark, with local talent. We've resisted the very attractive urge to go overseas and leverage developer pools from other parts of the world. And what we've done is go to the local universities, and this is before AI emerged, find smart kids in mechatronics, in software engineering, in computer science, bring them in and have them work in our business 2 or 3 days a week instead of flipping burgers or pulling beers to get themselves through uni. And then most of those young kids have matured into fantastic young gentlemen and ladies and have moved into full-time roles with us. So we've really grown, and it's those kids, those young folk, not us middle-aged humans, that are more adept and more basically grown up with the concept of AI. So we've also got some fantastic partners. Of course, AI is about building models, and to build models, you need training data. One of our big advantages is we've got one of the world's largest libraries of training data. And so when we combine what we can do with 3D, we partner with people who've got fantastic training, fantastic models for 2D data, and that just builds into the strength of our analytics solution.
I'm going to try and combine 2 questions here into one. It's basically talking about, the cash flows quarter to quarter, revenue quarter to quarter, has been very, up and down. Is that inherent in the business? It is just going to be a lumpy business depending on when, one big customer says yes to something versus not, or as you kind of get more up that 3-point pyramid that you had, the revenue kind of will be more consistent because it's going to turn into more AIR rather than the kind of a project-based focused revenue that is kind of necessary at the start, if I can say that.
Yes. Yeah, so you've identified the bridge there and the journey into enterprise happiness, and that is you start with projects and you hope to deploy that into a recurring enterprise subscription. The US utility sector are very much project related. They focus each year, it's a project. And so we're working with our biggest customers and it's a journey to convince them that it's actually it's a recurring thing, and it's a subscription approach, and you'd be better off contracting with us in a subscription model. And that's a goal for that part of the market. The smaller end of town is very subscription based, and when we started the business, we thought we'd be here today with 10 or 15,000 customers paying us, a few $100 a month, a bit like a sort of Atlassian or a Xero model. That's kind of what we conceived. What we've realised though is that there is a bigger prize, and that's in the 7 and 8 figure ARR customers, but projects are a way into that. So yeah, you will see lumpiness, over the journey. You've seen it in the past, so that shouldn't surprise anyone. And all I can say is that as we continue to grow ARR, that lumpiness relative to costs will become less important. At the moment, we're tracking, we've been tracking costs and revenue like this, but as we move through that inflection point for operational leverage, and we start to see daylight between costs and revenue that's then expressed obviously as earnings, we'll be less susceptible to those quarterly swings.
Another question here on market structure, competition. There's a lot of large companies in this space, other digital twin providers. Where does 3DP stand in terms of competing with them and forging its own identity in the market, given you've got kind of bigger competitors?
Mark, virtually every big enterprise has had a crack at a digital twin solution or a digital transformation program. We're working with an oil and gas prospect at the moment, scoping out a possible deployment, and they've spent $100 million on a digital twin platform, and it's still to be deployed into operations. We're working with another oil and gas prospect who, and again, scoping out a deployment where they've had a go with all the traditional. Everyone's had a go, and digital twins. I guess the first point is digital twins mean different things to different people. So you can put it in a box and call it something else. Our view is that we're trying to stay in our lane. Our lane is create a common data environment, get all the digital twin data, whether it's imagery, whether it's 3D, whether it's 3D design drawings, 2D design drawings, PDFs, IoT sensors. You create a place where people, and with APIs at either end, deployed into the enterprise, people can come from other enterprise applications into Pointerra or out of Pointerra. And we basically become the glue that brings together a whole bunch of financial and operational solutions that they've currently got deployed. And what the market's telling us is that there aren't many people out there that can actually do that. They a lot talk about it and a lot put up a PowerPoint and say, this is our digital twin solution. And some of these organizations, as I said, have spent big bucks trying to deploy, and they haven't been able to. What we know and what our customers and prospects tell us is that our platform, the scalability, the performance, the always on, the ability to build really quickly, dynamically build and deploy analytics is unprecedented. So we think we've got a great blue ocean opportunity, a great moat, all the things that investors love to hear. We know the TAMs across the different sectors are massive, and our single biggest hurdle is sales execution, and that means quality people. So the focus to take the business from where it's been to where it is now and return to growth, as I said, in FY25 and beyond, is quality people.
Ian, we're bang on time there, and as I said, unfortunately we didn't get to all the questions, so apologies.
Send them through, Mark, and I'll send them through, and I'll answer them, and maybe you can push them out to your audience.
Yeah, no, for sure. Ian, we do have our next Pertbait presenter waiting in the wings here, so if I could ask you to please stop sharing your screen, and delighted to welcome back no stranger to the Coffee Microcaps audience, in person and online. We've had him on both now. Chris Clark from RocketDNA. Chris, a good follow on from Ian. You're kind of in the same space, same but different.
Yes. Good morning, Mark. Good morning, everyone, and thanks Fernanda for organising the session. It's definitely an interesting sort of segue into from digital twins and geospatial data into very much similar to what we do, using tools like Ian's into what we do in terms of delivering full blown geospatial solutions for our end customers as well. So very excited to be here. I think a little bit about, for those of you who don't know about Rocket and who we are and what we do, we've been around for just over 12 years now, and have really sort of focused on our niche of the ability of drone and high resolution data to be able to be deployed in these very fast changing environments to be able to process and provide insights in near real time. And we really, what we do as a business is that we're able to really build a moat around the drone sort of regulatory approvals, as well as our drone and our integration skills around software to deliver a complete solution that enables these enterprises in obtaining this data very, very quickly. A quick little snapshot of the business and where we're at. We're a 6 million revenue business for last year, sort of 23, and the revenue is primarily built on long-term recurring revenue contracts. So we're going to these large mining tier 1, tier 2 customers, signing up long-term deals and deploying our solutions there, because this is it's information that they need on a continuous basis to enable their operations or to optimize what they're doing on site. Our market has traditionally been within the mining space, but we're seeing a really growing segment within the oil and gas and even renewable energy sectors as well. So as a small microcap, we're very proud of the sort of the journey that we've been on in terms of positioning the business for growth. And we're very exciting in terms of the opportunities that are now being realized within the enterprise segment. As sort of mentioned, we traditionally deal with these large customers, B2Bs, in this space, and typically these are the kind of the deals that take a little bit longer to negotiate. They sometimes take a bit of a while to onboard, because even to get, let's say, a single unit or single product on site, because what we do is it's not a pure software, it's a combination of hardware, software, and people to deliver these on-site solutions. And to go through the entire process, you need to tick all the safety, the cybersecurity, and all the other sort of regulatory boxes that need to get on there for the very first unit. And what's really exciting about our business is that how we've sort of repositioned it for growth in the new autonomous segment, specifically focused within these sort of arenas of workflows that are requiring sort of automation. Just sort of as an example, we looking at these large scale mining companies and how they deploy sort of drones and drone data. You've got large sort of, let's say, the largest sort of operator of drones in the Pilbara has got about 400 pilots deployed, collecting drone data, and they're looking to automate about 25% of that process flow using new sort of drone technology, right? And this is mainly around the constraints around getting labor onto site, finding the skills necessary, and essentially the time saving and the cost factors associated with getting out there and collecting that data. So we've really built a product around focusing on how do we automate that side and essentially provide the data output, which is what the customers are essentially looking for. We're very proud is also how far we've come in the last couple of years. We had a particular idea and a goal and strategy which we wanted to target. I think a lot of people think what we do is got a very is almost a little too niche. But what our sort of argument to that is, it's really about we've sort of seen the applications of drones is only growing. It's probably just what sort of people's perceptions when they think about drone technology is very much sort of what you see on the consumer sort of end, but really in the sort of the quiet back end of the enterprise realm, you've got tens of thousands of drones which are operating, collecting data on a daily basis, and how that is collected and how that is processed and interpreted is really key into delivering a sustainable solution over a continuous period and on a very frequent basis. And what we always wanted to do as a company is really understand the problems that the customers were having on site, and really not try to reinvent the wheel, but rather automate that wheel as best as possible. And I'll chat a little bit about our new product launch a little bit later as well. In terms of our financials, it's again, we're primarily, majority of our revenues is from a recurring revenue base. We do have a segment of it that is project related, but primarily it's all about, signing up these long-term contracts, this incremental growth over time within the business. And that's allowed us to employ and develop the business and build these new products within sort of our own stable as well, and turn them around very quickly. So we're very proud in how far we've come and how flexible, adaptable we are to understanding our clients and the market within this space as well. A couple of examples of workflows that we automate and really based on all our experience predominantly within this mining industry and a little bit within the agriculture space, is we're focusing on so that 80-20 principle is saying, what do majority of our customers do that we can look to automate using the drones and the software components to really kind of spare up their time and allow them to focus on what they need to do. So this would all go from using drones and our technology solutions all the way in the exploration space into predominantly what we do a lot of is within the survey planning and providing volumetrics. But where we're also seeing a really big growth areas within geotechnical. So this is understanding the safety components and essentially the rock mass, the composition, and the pit conformance aspects of the open pit mining arena as well. And then all the other sort of safety elements when it comes to sort of tailing storage facilities as well, and probably bleeding into a little bit of what Pointerra does is on the construction and infrastructure space. So using drones to do continuous progress monitoring and drawing these heat maps to show where the progress may be lacking or ahead of target as well. We see a very strong growth sector within the security and surveillance space. That also is a really strong sector, and we've seen a couple of government tenders come out with specifically targeting this. So using drones in a proactive security perimeter patrolling application to allow them to really detect and mitigate against any risks that are coming people into these very sensitive or sort of high risk areas. What makes us unique versus any of the other competition is we've already taken the last couple of years to build up a lot of these regulatory approvals and our ability to interact with enterprise customers at their level. I think there are very few, if any, that can actually tick all the boxes in understanding what do enterprise companies need in order to outsource their regular drone services on a regular basis. One of the big ones that we've achieved over the years is beyond visual line of sight, but in addition to that is what we call remote beyond visual line of sight. So this allows us the capability to not needing to be able to deploy a human with the drone on site, but be able to only just deploy the drone in a box product and allow that to capture all the data remotely. And that's been a really successful part of sort of our new strategy and new product growth arena. We've seen a lot of sort of pipeline building within that space as well, and a lot of positive customer feedback and growth within that new product segment. A couple of the financial highlights are based on our last sort of quarterly results, which we just sort of finished up, which we released about sort of just under 2 weeks ago. It's really all about growing again that ARR component. The business is from a net cash point of view from the last sort of quarterly only burning about just over about 100,000 compared to just over 300 the prior quarter. So as a team, we're always very conscious of the cash burn and what's needed to develop and grow and expand this business, because you've already essentially got two stages of it. You've got this sort of, I would say, the legacy part of the business, which is again where we're taking people and deploying them out to these contracts and fulfilling these jobs and these opportunities. But then you've also got the new growth arena, which is all about the automation element and product that's very new and that we're expanding on. So finding the balance between maintaining the current and growing the existing revenue base, but as well as expanding on that with our new products is sort of that really interesting balance that we're always keen and focused on as well. So we've just really kind of taken the time to make these very much these small adjustments. How do we use all the sort of the skills and the capacity that we've got on board to get us to that next step of the growth phase, and which is really about, as an example, you can sort of see there the Calidus announcement, really focused about deploying our new XBot solution, which is it's a really easy product and really easy for customers to see, and once we sort of put them in an initial sort of trial, customers just don't want these units to leave. So we're really quite positive about the strategy which we've adopted and where we're headed, and I'm very excited on the sort of next phase. I won't probably rest too long, but this is all available via the website or on the ASX platform as well. But again, the business has all just been about consistent growth, focused on getting the basics and the first principles right in what we're doing. A lot of the current revenues, what you're seeing is again coming out of that legacy part of the business with the new product revenue starting to reflect slightly now in the new quarterlies. as mentioned a little bit earlier, there's a lot more dynamics to RocketDNA and our revenue stream as well. You've got the recurring revenue business. We've got customers who've been with us for a very long time, and then you've got project-related revenue, which essentially is a reflection of our pipeline. Customers coming in want to do a proof of concept before moving into a longer-term arrangement. This is a quick sort of highlight about sort of the cash basis as well, how we've sort of managed the cash flow process over the time, and you can sort of see over the sort of last year when we had to sort of R&D and develop the product, where we had to burn a little bit more cash, but how we're able to sort of rein that in and show that the business is on the right trajectory for profitability as well, which we're very excited to achieve in the short term. And sort of building on the sort of the catalyst within the announcement as well, the continuing sort of growth. You know, our model has always been about offering and signing up long-term contracts. I think it's while it's always you know, very appealing and sexy to sell, you know, once-off big $1 million sort of deals all at a time, and we'll never say no to that. But we're also understanding it's just as key to build the small wins over the long terms, because that builds, you know, you sort of build a business a lot more responsibly, step by step, as the sort of one single revenue comes in from 1, 2, 3 products as well. We sort of expand and use those monies to continue to grow that business, saying that we're not only just focused on the one-to-one sort of sales as well. We understand that the conversations that are being had around the autonomous product and at the large scale sort of missions and the problems that it can solve are also being had in terms of from an asset management perspective, and really sort of speaking to these large players and how do you deploy 10s and 20s of them. And probably to give you a little bit of an example of, you know, what we've been up to and what sort of our focus is for the next couple of months is really around our autonomous export solution. So we've taken about 60 different components, pulled this all together into a solution, and taken the time to get all the regulatory approvals done. And this has been by no means any small feat. It's a really complex process in that you're involving all these specialty skills from aviators, technology personnel, engineers, surveyors, all these inputs together to build a solution that can actually be deployed and remotely and entirely left alone to continually run. And the solution that we've built and tried and tested over the last year has been fully robust, and it's actually built a lot of confidence in customers now to start including this as part of their strategy and their long-term growth plans within the business as well. And the way in which it essentially works, I'll sort of put the photo up here as well, is that you have the unit here on the left, which we call an export unit. So we take a whole lot of different components, whether that be a DJI box or Skydio, or, you know, we're pretty agnostic in the terms of the actual hardwares, but we pull this all together, we certify it, take it through so the electrical certification sort of process, and build a solution that's fit for purpose and scalable. And once these units are then deployed to site, they're collecting data on a daily basis. So this continuous flying, you know, about 80% of it is scheduled, and what you're seeing is that data then, as the drone comes back, it lands in this box, and then the data is sort of transmitted and shared with the customer. In the top right, you can see sort of a snapshot of one of the stations at our remote operating center. So there's always going to be a human in the loop, according to the CAS approvals. You know, someone who's monitoring the drone, even though it's pretty much operating on autopilot. But you need that human or that remote operator there who's monitoring the weather, monitoring the air traffic, you know, performing deconfliction if necessary as well, and just essentially someone to call if there's ever an on-demand request on an emergency on site that needs to be filmed. We're seeing a lot of those kind of requests coming from customers where, you know, these units are deployed. They're primarily being used for surveying and modeling on site, but then we're seeing the growth coming in a lot of the ad hoc and on-demand applications, such as if it be emergency, or even using AI to do water leak detection. So running a drone every single day over a 10-kilometer pipeline or a conveyor, doing thermal and image analysis, and actually looking for damp spots along that water pipeline. And again, you're constantly removing people who've been doing these dull, dirty, dangerous, boring tasks, and we're sort of fully automating that. So it's been a really validating experience that over the last year, as we've sort of built and deployed the solution, we also realized that by taking a human out of the loop and not having a person on site anymore, we had to create a front-end application, which you see in the bottom left is our SiteTube application as well. So as the drone is flying, you're getting a live video feed, or as the drone to lands, uploads all the photos and the videos which were recorded, and essentially makes it available to the customers in a raw format that they're able to sort of consume it. And you'll be amazed that like even simple things like this, where customers are getting this daily near real-time video feed back to in the palm of their hands before they even get out of bed, is made it so that some of the sites we deployed it, there's like 60 users subscribed out of that one customer site, that everybody wants that data, because now they're using it in their daily management meetings and their handover meetings. It's becoming so ingrained. And what we're very excited as a business, and I think it's probably really important to sort of clarify the phased approach that we're taking here, is we're really in the phase right now of land grabbing. It's about putting the units out there and really just getting the customers through the change management process. And the software application layers becomes the secondary step, where then customers start asking, well, what else can you do? Other than just surveying and emergency response. And that's where we're bringing in the conveyors, the water pipelines, all these very unique and interesting applications that the customers are requesting, and you're getting it all from a single unit. So that essentially increases the stickiness factor of who we are and what we're doing for these customers, because you're just seeing that more geospatial data. Customers are becoming a lot more acclimatized to what it means and how to handle it, and the software applications involved. And so, we're very excited in how the deployments are going. And maybe as a sort of a brief example, and sort of shows you some of the chats, you're able to add on additional sensors and sirens and lights to these units. And one of the applications is, again, is automating these tasks such as methane detection, not only in oil and gas, but even in mining environments where you're drilling and exposing dangerous gases. So this allows you to detect and be proactive in how we really address these sort of growing concerns within these environments. And these are kind of the scenarios as we're going out and chatting to clients, that they get very excited, particularly when you're thinking about drone technology. Is really about, you want to focus on issues on a micro scale. And as an example, you're able to automate your assets and plant inspection. So once you've kind of built your digital twin and you've got assets of concern, you can then be programming the drone on a systematic basis to be able to go and every day at that time, at the same angle, the same height, take photos of insulators, look at the corrosion, understand the nuts and the bolts of everything that's happening on site. And this is really that, again, just that phase one layer of just starting off, understanding what the clients want, and then building the software processes behind that to allow them to consume and make decisions on a very frequent basis. And probably to sort of skip quickly through, but to give an idea, like the solution we're delivering for Calidus, they really had a requirement where they were struggling to really just get surveyors out to these very far remote regional sites. It's some of the most remote sites in Australia, and just to be able to know what the mill was producing on a daily basis. And this where our XBot solution is going to be deployed, combined with our Straios tool, is essentially providing automated stockpile volumetrics on a daily basis. And this just happens continuously. They've got a system they can obviously log into, a visualization tool to get and calculate it, or they just essentially just get emailed the PDF and the Excel. I think that's probably where I'll sort of leave it for now, Mark, and be open to any questions.
Thanks, Chris. One, I just wanted to touch on the let's stay with the new products, the the XBot solution and stuff. In terms of, yeah, I think Calidus are taking 5 of these, if I remember from the announcement. Is that just refresh my memory?
No, so we've deployed 5 of them currently. Calidus has taken 6, including in South Africa as well, and then we're starting our next deployment of 5 units at the moment. So a couple of these are going out in a trial phase, and some of them are going out for paying customers.
Okay, yeah, that's where I wanted to get to the which was Calidus and which are the new ones. So in terms of these proofs of concepts with the new customers, one of the questions I had is, do you get paid for these proof of concepts? And then what is the kind of timeline of, do these customers want to see it over a month, a 3-month span? Just talk us through, if now that we have the kind of Calidus experience of, proof of concepts to actually signing a contract, and then they're rolling out more than just maybe the 1 or 2 units that they've had as part of the proof of concept. Maybe just talk us through that timeline so people kind of get a better idea of, okay, you're doing proof of concepts, but how long until we, get to the end result of, an announcement of contract wins?
Yeah, it's a very interesting question, Mark. And it's a very also an interesting space for anyone in any business that's building a new product, right? Like, sort of finding that. So when you're developing something unique as this, it's a tool that can be used from large tier 1s all the way to the tier 3s in the mining world, but can also be deployed again, oil and gas, renewable energy, like you can just think about the some of the large solar farms that projects that they need to sort of continuously keep monitoring, their solar farms, right? And what we've really kind of seen is from a trial perspective. So maybe I'll take a step back and say we are so confident in the solution now that we don't actually offer any more free trials. So we've sort of taken it now to the point of view we make it very easy for customers to buy and lease the unit even on a month-to-month basis, but we're not offering any more free trials from our side. We do have very large tier 1 customers on trial, and that was more of a strategic decision as a business, because these are the kind of clients again who go from 1 to 100 in a very short space of time. And probably, when you're thinking of tier 1s, I mean, it's probably could take, 2, 3, 4 years. You never know, how that those sort of roll out, but they can make the decision at one place. And I think it's really important for everyone to know this is not a case of we're creating something new or reinventing the wheel. These customers already are using drones on their sites, right? But they're paying very expensive engineers to go out and collect all this data. And we're really sort of leveraging and disrupting the part where we're saying drone data collection is fully commoditized now, and bringing together the right technology and actually probably outsourcing that is actually the way that this is all going to be going, right? That where vast majority of all drone data collected will all be done autonomously. And so that's where we're leaning into it. In terms of the tier 2s and the tier 3s, the sales cycles are a lot quicker. So we don't have a constraint in the sales. We actually have too many opportunities. I think it's about, because we're the sort of the leading factor in this, and especially in this this sort of format of the drone in a box, right? I think a lot of people previously, like drone in a box is not a new concept, but previously there were very big, large, complex, very expensive systems, and now we've managed to really containerize this and I use the word fit for purpose, but these systems are probably 3 times cheaper than hiring a surveyor, and that's the comparables, and that's the attractiveness where people are saying, right, it's now at the price point where we can start deploying, start replacing a lot of our standard or manual drone data collection, and rather bring those people back into the office to focus on either the data processing or the data reporting element.
And then in terms of typical contracts, the Calidus one that's come through, for the drawn the box solution. Is that kind of what, you know, most of the contracts are going to look like? It's going to be a kind of a 3-year piece rather than, you know, a 1 year with an annual renewal. Is that kind of, if we're looking down the road 12, 18 months from now, any more further drawn the box contracts will kind of have that kind of 3-year cadence?
Yeah, so when we're presenting this, we're obviously presenting multiple options to customers, and again, I guess like with your vehicle, right, Mark, the longer you sort of lease it over, the more cost effective the OPEX, the per month cost is, right? So customers are price sensitive, especially in this inflation environment, which again leads on to why they're so open to automation and our XBot solution as an option within their sites. So yes, the average is coming at around about the 3-year sort of mark, where we're seeing customers you know, are very comfortable with. But more on top of that, Mark, you know, again, it's you're sort of seeing the customers start off with 1 again, and it takes that while to you know, tick all the safety boxes, get on site, get the customers, you know, just used to how they receive a data. Instead of from a human, you now have to, you know, go through a web interface and download your data. And, you know, it's just, you know, even you know, to us, it seems pretty simple, but you know, it's still a big change management process that you know, we need to go through with the customers, because there's no face on site. They're all sitting in a remote operating center. And so customers are starting off with 1, and then they're expanding 2, 3, 4, 5. Like, and that's where we see this growing is again, they need it everywhere. They start with 1 now, and then they expand the rest to cover the rest of their operations, because these particular units only have a range of, you know, 5 to 6 kilometers. So let's say, you know, sort of 5 square kilometers, so 10 kilometers point to point. So you need to deploy multiple of these units to cover your operations if they're large or spread over vast geographic areas.
Yeah, no, exactly. And 2.0 of, you know, the model that we see on the skid here is, you know, as you kind of get more units rolled out and more proof of concepts, you know, are you finding, you know, new improvements and, you know, potentially kind of little add-ons that you can give to customers down the line? Is that something that's starting to come true? You know, because it's great having the first unit, but you know, you'll have so much more experience after 10 or 12 units that actually there's actually more we can do here. Is that starting to come true now that you've got more units physically operating in the field and getting that customer feedback, as opposed to, you know, testing it in the workshop?
Yeah. So again, I guess things, speaking to our culture and our principle of always sort of that 80-20 rule, right? We want to build economies of scale. We want to be standardizing the product so that it can be rapidly deployed and, you know, put out to site. And these are like, we really feel we've got it there. You can put this unit and have it flying in half a day. It's all the things on the other side, you know, again, around safety and getting power to the unit and all of this that just take a little bit longer. But in terms of the unit, it works from day one. And but saying that, we own this. This is our IP. We own, you know, the complete sort of phase, right, from all the assembly of it all the way to the software components. Like, we manage all of that, and there's about, again, 60 components that all come together to make the solution work. So it's not just what you see on you know, on the front end there. It's also what's all happening in the back end in the remote operating center, from managing human fatigue, you know, awareness. It's there's a lot of factors that sort of got to be considered in deploying a scalable solution. And we're all about how do we make this as efficient as possible. So not just from a hardware construction point of view, but we even, you know, recently got you know, sort of approvals to do, you know, 1 to 5 operations. So a single remote operator controlling 5 of these at the same time. So the efficiencies just continues to get better and better and better. And thus we can drive the cost points down, and essentially making drone data and high resolution data a continuous feature on these enterprise sites.
Yeah. Chris, we are actually, sorry, we've slightly gone over time, so I don't want to take up any more of your time. Apologies for that. Thank you very much for coming back and joining us once again. It was good to get another update from RocketDNA, and yeah, we'll keep an eye on the ASX announcements page for hopefully a few more of these contracts coming through and multiple units going on to sites around the country.
Thank you, Mark. Appreciate it.
Thanks, everyone. And just a reminder that yesterday's recording, we had 4 companies presenting yesterday. The 4th this morning, they'll be going up on the Coffee Microcaps YouTube channel early next week. And I wish everybody a good Friday and a good weekend. And we'll leave it there. Thank you.